Three things changed overnight that every Canadian investor needs to know. First, the 50% tariffs on Canadian goods that were set to hit at midnight last night paused. Trump and Carney apparently have a deal. We have 3 days to find out what Canada actually agreed to. Second, the US Treasury intervened in the bond market this morning in a way it has not done in years, doubling its debt buybacks targeting the longest duration bonds after the 30-year yield hit a 19-year high yesterday. Markets surged on the announcement. Third, the Fed's July meeting minutes dropped this afternoon. The vote was 9-3. 3 governors voted to hike rates, the most fractured Fed vote in a decade. But the data that arrived after the meeting undercuts their case almost completely. 3 separate stories, all with direct Canadian implications, all brand new today, Tuesday night, 90 minutes before midnight. Trump posted on Truth Social, "I have paused the 50% tariffs against Canada that were scheduled to kick in tomorrow morning for a 3-day period based on the fact that Canada and the USA, subject to the finalization of documents, have a deal." Carney's response was more measured. "Substantial progress has been made," he said, "but there is important work still to be done." Those two statements, "we have a deal" and "there is important work still to be done," are not the same thing. That gap is the most important thing to hold in your head as you watch the next 72 hours. Here is what we know. The tariffs that were paused covered dairy, alcohol, and furniture, approximately $20 billion in Canadian imports, representing roughly 5% of Canada's total goods exported to the U.S. They were authorized under Section 338 of the Tariff Act of 1930, a rarely used law with no built-in time limit, meaning these could have stayed in place indefinitely unless Trump or a future president chose to remove them. Earlier this year, the Supreme Court struck down Trump's sweeping tariffs, the ones applied broadly under emergency economic authority. These Section 338 duties were a different legal mechanism, a workaround, and they faced different legal vulnerabilities. The pause buys time to negotiate rather than fight in court. The White House described the deal framework as comprehensive market access for American goods, economic security commitments, and digital trade alignment. Trump also floated Keystone XL, the pipeline canceled by Biden, as something that may be awoken from the grave. Here is what we do not know. What Canada gave up. There are no specifics on the Canadian concession side. Did Carney agree to drop retaliatory tariffs, open dairy markets further, accelerate defense spending commitments? We do not know yet, and the details matter more than the headline. The deadline is Friday, August 22nd at 12:01 a.m. If documents are not finalized, the 50% tariffs take effect Saturday morning. This is not resolved. It is a 72-hour window. For Canadian investors, a genuine Canada-US trade deal would remove a significant structural risk from the Canadian economy, one the Bank of Canada has explicitly identified as a top threat to its growth and inflation outlook. Tariff certainty supports Canadian business investment, reduces supply chain disruption, and removes a reason for the BOC to stay more cautious than the data alone would require. A deal would be genuinely positive for the TSX, the Canadian dollar, and the BOC's policy flexibility. A breakdown by Friday morning would be the opposite. Yesterday, the 30-year US Treasury yield hit 5.33%. That is not just a high number in isolation. It is the highest level in 19 years. And it did not happen alone. Simultaneously, Japan's 10-year yield hit a 3-decade peak. France's 30-year rose to levels last seen in 2008. Germany's 30-year Bund reached its highest since 2011. This was a coordinated global sovereign debt sell-off. Governments around the world seeing investors demand higher compensation to hold long-term government bonds. The reason? Oil above $90 on Hormuz uncertainty, sticky inflation expectations, and growing concern about the long-term trajectory of government debt in multiple major economies. This morning, Treasury Secretary Scott Bessent responded. The Treasury Department announced it would at least double its government debt buyback operations from $2 billion per operation to at least $4 billion, targeting specifically the 10 to 20-year and 20 to 30-year portions of the market. The program runs from September 9th through November 4th. The effect was immediate. The 30-year yield fell 9 basis points from 5.33% to 5.196%. The 10-year fell 6 basis points to 4.647%. Stocks surged. The Dow gained 360 points at the session high. Lowe's and Home Depot both gained approximately 2% as rate-sensitive stocks responded to lower yields. The Treasury statement said the buybacks are not intended to mitigate episodes of acute market stress, but that is functionally what they are doing. And markets read the action, not the language. Two things worth understanding about what this actually means. First, the scale. The Treasury is buying $4 billion of bonds per operation in a $30 trillion U.S. government debt market. That is approximately 0.013% of the market per purchase. The buybacks alone do not determine where long-term rates go. The symbolism is what moved markets today. The signal that Treasury is watching the long end and is willing to intervene. Second, the timing. The program runs through November 4th, which is the final stretch of the U.S. midterm campaign. Bond markets and political calendars are rarely unconnected. Higher long-term yields make government borrowing more expensive and create economic headwinds that show up at the ballot box. Whether the timing is coincidence or not, it is noted. For Canadian investors, U.S. long-term yields feed directly into Canadian mortgage rates, bond markets, and the relative attractiveness of Canadian versus U.S. fixed income. When the U.S. 30-year yield falls, Canadian bond yields tend to follow with a lag. That matters for anyone holding bond ETFs, for the BOC's assessment of financial conditions, and for the rate-sensitive sectors of the TSX that have been under pressure during the yield spike. The Fed's July meeting minutes released this afternoon. The vote was 9-3. 3 governors, Beth Hammack of the Cleveland Fed, Neil Kashkari of the Minneapolis Fed, and Lori Logan of the Dallas Fed, each voted to raise rates by a quarter point. Not hold, raise. That is the most divided hawkish dissent since September 2016, a decade without a 3-governor vote to hike. And it is not just the 3 who voted. 2 additional non-voting members subsequently indicated they would have backed a hike if they had been voting. That makes it effectively 5 of the 12 who wanted to raise rates at the July meeting. The minutes captured the hawkish argument clearly. Supply shocks from the Hormuz disruption and the AI investment boom could entrench inflation above target. The labor market remained stable enough to give the Fed room to prioritize price stability. Current financial conditions might not be tight enough to bring inflation back to 2%. Fed Chair Warsh's fingerprints are visible throughout the minutes. He initiated a discussion about reducing FOMC meetings from 8 to 6 per year, arguing that fewer meetings would allow more data to accumulate between decisions and give policymakers more time for strategic thinking. The committee discussed it, reached no conclusion, and Warsh confirmed 2026's remaining meetings proceed on the existing schedule. Worth watching. This could structurally change how the Fed communicates if it eventually passes. Here is the critical context for everything you just heard. The July minutes reflect a conversation that happened before 3 consecutive data releases completely undermined the hawkish case. July payrolls, negative 23,000 jobs, the first monthly contraction in years. Consensus was positive 80,000. July CPI, 3.4%, core at 2.5%, both below estimates. July retail sales, negative 0.6%, the weakest reading since May 2025. Every single data point released after the July meeting moved against the hawks. A labor market that was stable in July contracted in August's data. Inflation came in softer than expected. Consumer spending fell. The probability of a September rate hike has dropped from 57% at the time of the July decision to approximately 31% today on CME FedWatch. The minutes are hawkish. The data is not. The minutes describe a July conversation. The September decision will be made on August and September data. Read them as historical context, not as a forward signal. 3 stories, each one genuinely new, each one with a specific Canadian implication. The tariff pause, 72 hours to determine whether the most significant Canada-US trade risk the Bank of Canada has been watching for months gets resolved or restarts. Trump says deal. Carney says progress. The concession details, which we do not yet know, are what this actually costs Canada. Friday morning is the deadline. The Treasury buyback. The U.S. government intervened in its own bond market today after the 30-year yield hit a 19-year high. The symbolism moved markets more than the scale. U.S. long yields falling feeds into Canadian mortgage benchmarks and rate-sensitive sectors. The program runs through November 4th, midterm season, and will be worth watching. The FOMC minutes, the most fractured Fed vote in a decade. 5 of 12 effectively wanted to hike in July. The hawkish case in the minutes has already been undercut by 3 straight data misses since the meeting. September hike odds fell from 57% to 31% on that data. Jackson Hole on August 28th, 9 days away, is where Chair Warsh gets to speak into all of this for the first time. That is the event that will actually tell you where the Fed goes next.